Hi everyone, today we're going to be going through a co-working feasibility study. We're going to be looking at a 1600 square meter or circa 17,200 square foot site. We'll pretend this is over one floor, okay? Because the commercials I'll be speaking to today really are focused around the product mix and how you attribute your revenue assumptions and even cost assumptions to them, because we'll cover staffing and everything like that. But the purpose of this video is to give you a pretty good understanding on how to approach a new co-working opportunity, whether it's your own building or you're looking to set one up in another landlord's asset, and apply it to yourself. You know, a lot of these assumptions are generalized for the purpose of this video, but please remember there is no one-size-fits-all solution. I've done lots of these videos so you can kind of go through my channel to see if there's one that's a particular size or in a market that's more representative for you. This one's just going to be in the US, let's call it Los Angeles. And yeah, you can have a look at those videos to see how I play around with different scenarios, whether it's multi-floor, single floor, if it's more amenity centric, if it's more commercially viable. But today's one is pretty important because I want to talk about what kind of profitability you should be targeting as an owner or an operator, because you've got capital considerations to put in, you've got management fee structures, all that kind of jazz. So before jumping in, also in the description, there's a couple of free materials, totally free, right? Which helps you validate your co-working opportunity, but also goes through in a bit more detail all the assumptions and calculations I'm going to go through today. So it's flex for thought. Which is what I call my channel. So feel free to grab those. And if you're working on something this year, because I think it's the year to do it, you can always book me for a free consult. There's a link in the description as well. So just reach out to me. We can talk about it, see if I can help you. Because all of the stuff I'm going to go through today is high level, but it really pays to have a proper commercial model built for your situation that you can use both for your feasibility, but also for your budgeting moving forward. And also, get to test fits, floor plans, proper staffing, structures, all that kind of stuff, right? So let's get started. It's a bit rainy today. I don't know if you can hear it. I'll try use the podcasting tool I've got to kind of buffer out that rain. Oh, if it rain's nice, you might like it. So today we're dealing with 17,222 square. We'll work in square feet, right, for this one. Site over one floor. And the density calculation we're going to go with is about 75 square foot per workstation. And if you watch my videos, you get a good understanding that there's certain industry benchmarks out there. You can go much more dense than this, especially if you're looking at more traditional serviced office operations. They could go as low as 55 to 60 because I really like to pack those desks in there. However, I think if you're watching this and you're trying to create something unique, and you're not looking to dominate the world by setting up 50 of these things, there's a really strong argument to be made. Try and let your space breathe a bit better because it supports productivity. It makes it slightly more premium. You're not trying to squeeze every dollar out of this necessarily, right? Because especially if you're setting up one, your overheads are a lot less. You're not paying this corporate machine upstairs that wants you to run like 50 of these. So the commercials can work in your favor to design something quite nice. Now, with that density calculation, how many desks does that look like? Across the 17,000 square feet, you've got about 229 desks, right? That's the total. But we need to understand how we want to split this into office, open plan, and even hot desks, right? I always normally like to have 80 to 85% of your total desks to the office scenario. So in that case, that would be 195 desks in office. So let's call that 85%. Is that 85%? Did I use that? Yep, 85%. And the rest you can kind of distribute to the open plans and the hot desks. So I think I've got 34 open plan and 10 hot desks. And the main reason for this, again, everyone, is office desks in private offices or suites. You normally sell those even in a flexible co-working arrangement, 6 to 12 months plus at a time. So when you think about your commercial P&L, that is stable revenue, much more stable than open plan or hot desks that are sold month to month. Imagine having a P&L and a floor plan where half of those desks are month to month. It's not the greatest business case for you to endeavor in, right? And additionally, if you're bringing in a partner to facilitate the CAPEX, or you're partnering with a landlord, they want to see stability as much as you can offer them with this variable style income model. Okay. Occupancy theory. I've got the spreadsheet next to me. I might pull up the inputs now so you can kind of see, if we go to the, I've pegged a lot of this. We've got monthly breakdowns, which I'll keep it to the years for this particular model, which I've simplified for the purpose of this video. But I'll open this up so we can look at some of the key inputs that you want to play around with. We're going to assume for the desks, we have an opening occupancy of about 30%. This could go down to as low as 20% if you want to be super conservative. But it's always good to open it around 20 to 30 because when you think about it, it means that the cash flow that's coming in as soon as you open gets to cover a lot of those setup costs, the staff that you need to hire, even the building costs, your triple N, your outgoings, all that kind of stuff. So you don't want to open at zero because then you're paying cash out of your pocket or the landlord's pocket, depending on how you structure that deal. So normally when you set up a business, there's 3 to 6 months, even sometimes up to 8 months, if you've really got this planned, of branding, pre-marketing, getting the message out there, working with brokers, even hiring your center manager or your on-site staff at least 2 to 3 months before you open so that they can sell, right? So you can open at 30%. Mature occupancy is 80 to 85%. We've modeled 85%, I believe. The smaller your space, the higher this percentage can be forecasted confidently. Because just when you think about it, you've just got less stock to sell, right? It's when you get into the realms of 3,000 or 33,000 square feet, 3,000 square meter or 33,000 square feet sites, you're probably going to want to forecast for 80% at any one time because you've got a lot of desks to sell. Right. And generally speaking, in co-working and flex, even if you're confident you can hit 100%, because your customers are rolling on these month to month or 6 to 12 month licenses, you're going to get pockets of time throughout the year where you might lose a customer, even though retention's really important. So it kind of accommodates for that fluctuation, right? If you budget for 100%, you're not going to hit 100% for the whole year. Very unlikely. And you ramp up for this particular one, we've ramped up for 12 months, right? I think Main purpose of this video, everyone, is we're going to go through these commercials and I'm going to write through it so I can explain it. And then towards the end, I'll jump into the model for the P&L breakdown, more importantly, so that we can talk through the numbers, right? So you can understand how that revenue flows down into the costs and how you should be talking to an owner or how you should be interpreting that as an operator. Ramp up of 12 months, I think, is confidently conservative, right? Especially for the smaller sites. Again, if you go bigger, you'll probably want to push that to the 15 to 18 month mark because you've just got way more stock to sell. And the size of the operation in today's market in 2026 and beyond isn't determined by greed anymore in terms of how much do I think I can pay for and operate, therefore push that economies of scale in my favor. Because around 2,000 or 22,000 square feet, 2,000 square meters, 22,000 square feet is when you get really healthy economies of scale for a co-working business because your staff's fixed. You don't necessarily need to add another headcount, your technology, a lot of your OPEX, which is why you've seen historically a lot of these massive co-working sites, like almost like a whole building of it, or 60 to 70,000 square feet. I think those days are gone, definitely, from everything that I've seen, both from my day job and even via people reaching out on YouTube. So, you want to just be careful. I think the future of co-working, particularly moving forward, are niche industry targeted sites that are around, the 20,000 square feet, the 15,000 to 20,000 square feet size. You can even go as low as 10,000 square feet. You just need to understand what your product mix is there and make sure you're putting things in that don't need to be serviced as much as a full-blown co-working operation, therefore keeping your staff headcount lower, right? I've got a note here saying phase 1 versus phase 2, just because lately I've been working on a couple of projects from people who have reached out in South Africa, in the US, in Canada, where it's a phased approach because they're new to this, meaning they may be speaking to a landlord or it might be their building and they see an opportunity for, let's take 10,000 square feet first. And if it does really well, then we'll take another 10,000 square feet because there's some vacancy to play with in the building, right? When you phase it, when I help them model it, phase 2 shouldn't kick in at month 6. I think it's month 8 to 12 when you factor in phase 2. Because the first 6 to 8 months, you're figuring out, you're going to be ramping up your business according to our 12-month ramp up, right? And just because that's happening in a really strong way, especially early on, doesn't mean that you can justify opening phase 2. You need to see at least, the first year of strength and then building up leads for the second phase, right, of co-working that you have. Plus, when you think about it, if phase 2 is on the same floor and it may not be another floor in the building, you may be taking part of a floor on the same floor, that build is going to take time for you to convert that extra floor you're getting, whether it's putting in more offices, open plan workstations, meeting rooms, or whatever. So you got to factor in that build. So when you have phase 2 money coming in, even if it kicks in at month 8, right, you're going to have to apply your own additional ramp up period from there. Maybe it's not 12 months, maybe it's 6, because you're piggybacking off the momentum of the phase 1 space. But you also have to understand it's going to take 3 to 6 months to build this thing, build this sucker. So even if by month 8, if we just kind of if we just think about this on the spot, even if by month 8 we're like, hell yeah, we're taking phase 2, you shouldn't be forecasting revenue coming from that place till, month 14, 16, realistically, depending on how quickly you can get it up and running. All right, meeting room theory. So this is always determined by the size of the space. Okay, I think it's very dangerous unless you have a particular model that is moving away from co-working that is very meeting and conferencing and events focused, which works in some markets. Like it's a cracker in London if you're watching this. A lot of great brands there that I admire, including Convene, that have really nailed that model because they know how to service those corporate events, cater, keep that bread and butter going versus the serviced office stuff. But if you're looking at a co-working scenario and you're focusing on this, I think for a space around 17,000 square feet, even though it's edging towards the slightly larger size, I still wouldn't go heavy on meeting rooms. I would go, what did I do here? Yeah, I did 4 meeting rooms here. So rub that out. I did 4 meeting rooms. And you cover your bases, right? You have like a 12p boardroom, you have an 8p, you have a 4p, and then I like to throw in like a podcast studio or a creator room there. Because I think that amenity is industry agnostic. Everyone's really creating content, especially corporate content, which I think will flood even more so moving forward. And having some sort of room to help facilitate, that's great. Plus those rooms are booked 3 to 4 hours at a time. They're not booked hour per hour. If someone's there to create content, they'll book out the room probably for the whole day to shoot, even edit in there, reshoot, all that kind of stuff. And when you see the success of certain brands, especially last year and the year before, that have really humanized their brand, got their messaging out, or growth because they've used social media and content to help them with it, everyone's going to follow and do it. So get one of those rooms in. I like that mix up because even if you go down to say 12,000 square feet, you can't go wrong having a big boardroom, an 8p and a 4p. Obviously, this is complemented by a lot of booths and phone booths. So you've got this scattered within your circulation, so people don't necessarily need to book a private meeting room as part of their membership package. They can just go bugger off and use a casual one or a phone booth. But I would still keep those even for the slightly smaller ones. And then the reality is, from a flexible approach perspective, if you find that the meeting rooms are going really well, you can always convert an office into a meeting room, especially the smaller ones, right? So if you've got some 4 to 6s or even 2 to 4p offices within your NLA that's kind of tucked away, that you're either having trouble selling or you haven't hit that area yet in terms of your filling occupancy targets, turn it into a meeting room, wheel in some AV there or set it up. It's better to reactively do more meeting rooms, I think, because there's been plenty of business cases and P&Ls I've seen where meeting rooms have just sat there because also there's seasonal revenue and income for you as an owner and an operator, meaning they're only booked per hour. They're not as guaranteed as office revenue, months, years, that kind of stuff. Because meeting rooms are dangerous in the sense that their dollar per square meter or square feet return eclipses offices if you put in ridiculous assumptions like, this meeting room is going to be sold 60% of the time of the hours that are available. It'll crush an office's return, but it's just not going to happen. Ask yourself, how many co-working spaces have you been to or offices have you been to where the meeting room has been booked all the time? And don't be biased because you like co-working. This isn't just during the busy periods throughout the whole year. And how many times have you walked past and that sucker's just been sitting there empty? Right? So just think about it. Be almost your own devil's advocate with this stuff. Event spaces, what do we got here? I'll move this back to the simplified dashboard so we can focus on this. I almost feel like I should block it. Let me know in the comments, please. Like, should I block out the financial model while I'm talking through these? Because is it just distracting having this glaring bright thing right next to my face? I was looking at a video the other day, and even though there's good stuff throughout, I'm wondering, is there just too much on the screen? Should I phase it? Like, should I do calculations and then bring up the model later rather than have everything up in front of me? It serves me shooting the video because my brain works like this way. It's scattered to the ends of the world. But please let me know in the comments. And additionally, in the comments, you got any questions, I will respond pretty quickly. Ask anything, operational, market, sales, personal, chuck it in there, please. Along with a like, if you don't mind, because it does help. So event spaces, you always have to think about too, private and or communal. And this really comes down to not just your member base, but how big is the building that you're putting your co-working operation in. If it's a large building with multiple tenants, I'd always try and throw in a private event space in there, especially if they don't have one in their own tenancy. That's potential free interest and free money, right? Because then even if they're trying to put new tenants in the building, you can speak to the landlord, be like, hey, we just built in a 20-person, small 20, 25-person seated a private event space into our co-working in LA, which we're going to sell to members, but also our team are going to externally sell to the market. But you can let your tenants know and your prospects that we've got this on whatever level you're on, so they don't need to build one into their own NLA, because they'll probably only use it sporadically, every couple of months. So it's better to book it than waste their own space. And communal, you should always, been doing this for years and I still rub out. Communal, you should always, this is really around the thoughtful design of your front of house area. How can you design your welcome area, your casual seating area, your cafe area or kitchenette in a way that during certain days or hours or seasons, it can blend and turn into a communal event space that members can book or be provided for free as part of their members package. That doesn't require confidential treatment. So it's not, we're going to do this market sensitive presentation. It's more, hey, everyone, Susie just got promoted. Let's all celebrate her in the really cool communal space within the co-working area of our footprint. Let's ask for some catering. Let's get some food, finger foods and some drinks and stuff like that. Let's book that. You should really be thinking about how to design your space to facilitate that as part of your NLA. So when you get smarter on how to kind of repurpose space that way, it really even helps with the activation of the space, right? The cafe, that was a bit loud, sorry. Again, if you watch my videos, I do not want you modeling for a cafe. No profit. And in this model, I don't think I even put it in there. No, I didn't. Because I've worked with hotel operators, including the Accor Hospitality Group. I've worked with private operators. These are experts, right? These aren't co-working operators trying to do food or coffee. Even if you're on the ground floor of the building and you can capture on-site street traffic, it is a tough racket to pull margin out of that unless you're a pro. Excuse me. So if you're on the ground floor and you have foot traffic and then you have a commercial kitchen and then you have catering into the building, then maybe you can consider it, because you've got your economies of scale. You've got the same staff, you've got all those costs, but then suddenly you've got more tools to play. Maybe the landlord throws in the commercial kitchen to sweeten the deal for you if you're on the ground floor, because then you've got multiple revenue streams, right? But if you're not on the ground floor and you're, say, on level 2 or even level 1 and you're not on the street, You've literally, it's the cafe should be treated almost just like an amenity, like a free service that you provide your members. But the return on investment on the cafe isn't the dollars it makes, but the way that you can justify your desk rates. Like I'll charge an extra $25 per desk when I market it because they get a cafe as part of their workspace versus the co-working space down the road that has no cafe. You know, that's where the premium and the experience stuff kicks in, right? And it doesn't have to be a fully fledged cafe. It could literally be a coffee cart. It could be a kitchenette area with self-service coffee with a really good coffee machine. And the coffee kiosk works really well if there's already a cafe operator in the building or nearby. You could literally knock on their door and be like, hey, if I design an area within my co-working NLA for you to pop in between 8 a.m. and 2 p.m. with one of your staff members and a kiosk, a coffee cart to sell coffee, would you be interested? That's amazing, right? They can earn an extra buck on staffing costs and cogs that they've already spent on, and you get an experience kind of wedged into your co-working space. So there's something to think about there. Additional revenue, this one is for you to think about, right? So this is specific to your industry. Because yes, you've got all the stuff, you've got like day passes, you've got, you know, all that stuff. Don't model day passes, please. I have yet to confidently see someone's back of house financials, which I have not just for my sites, but also other operator sites within the market, where day passes even move the needle. Day passes are more of a tool for people to get exposed to your brand and then convert them into an office or a meeting room or something else. Do not try and make your financial model look better because you're assuming that you're going to sell 365 day passes for the year or even a couple of hundred for $50 a pop or whatever. You know, do not claw revenue that way. If you're in a situation where you're modeling this and you're looking for ideas to claw additional revenue for stuff that you cannot guarantee, you need to relook at the things that do matter, like your layout, your product mix, how you're positioning it. Is it even the right market and building? All stuff I can help you on if you reach out. But the main thing I think is interesting from additional revenue is your specific industry. You know, are you in medtech? Are you doing this for targeting architecture? Are you in sports tech? You know, all these kind of things. What can you offer them by being part of this community and this niche co-working space, right? Because we've kind of modeled in this scenario that I'm showing you under ancillary revenue, like virtual mailing and address, concierge services, all that crap, which is a co-working space's bread and butter. So very low. We've made some conservative assumptions there, but you should really think about what specific services that you can provide. Staffing structure. So for this one, you know, your roles and responsibility, you've got your center manager, who's your main person that's responsible. Let's just call it for the P&L of the space. I'm dumbing this down. You got your community manager. That's activation and retention. They'd also be doing the tours and everything. And then your concierge, right? The front of house, the face, the smile that meets anyone for the first time. So you got three key roles, right? For a space of this size, you only need 2 headcount. So it'd be a center manager and you do a hybrid role of these two. As you get bigger, you can add a 3rd headcount. But again, it becomes very specific to your co-working operation because I'm working on opportunities now where it's plugging into a wider vision, you know, whether it's life sciences or whatever, and they require an extra specialist or someone to help service certain maker spaces or areas within the co-working space. Then you add to the on-site staff structure, obviously. But then you have to ask yourself the question, well, is that a burden that the co-working P&L should take, or is that some wider initiative that can be pushed into building outgoings costs because the owner wants to do certain things, right? Because all of these questions matter and all of these can be negotiated in a very fair manner. And if you're watching this and you're exploring a management fee structure in the first place, a partnership, you should be having these conversations. Because the only reason a landlord should explore this with you is if you're thinking about their building and their wider tenants, not just your co-working people, right? Building concierge, I put a question mark in here because, again, lots of opportunities where the ground floor needs a building concierge, owner's budgeted for it. If you're going in there and the timing marries up, what does it look like if you take on that scope? There's a fee there up for grabs. You can put it into your return as the operator, and potentially you can remove one of the staff costs within your co-working P&L, because the building concierge would also act as the co-working concierge if you design it correctly, if you've also got ground floor presence, right, which makes the whole thing look better as well, because that has already been budgeted for by the owner to put someone in the lobby. Okay. Technology, you always have to think about your internet and network, right? High-speed Wi-Fi, what are you going to go with? Those are also contributing to your setup and your upfront costs, the infrastructure. And then also you need to think about your booking and your billing platform. And so your back end and your front end. Do not build your own app. There's plenty of white label providers out there that rebrand on your behalf. So they provide you the engine, and then you can change the branding with them to whatever you want to call your co-working space. Because when you're starting to deal with, okay, so we've got 195 desks in this scenario in the office. Let's say, let's just have some fun with this. 195 desks, let's say in your market, the average size that you sell is probably 5. You've got 39 customers of the offices. You've got 34 open plan desks. Let's say that's a total of 20 customers, because you get a bunch of people taking single desks, but then some take multiple. So we'll do 20, and then hot desks another 10. You're dealing with 69 customers with billing constantly rolling. Every 69, I didn't mean for that number to come out like that. Very immature of me, but 69 customers and month-to-month billing, all that kind of jazz. You don't want to just be dealing with that on a spreadsheet and someone just responsible for that be like, oh gosh, is this person coming up? What do we bill them? What incentive are we providing? Are we taking that incentive away because, the first time we onboarded them, we gave them 3 months free for a 12-month deal, but we need to ease them back into the 12-month pricing. Otherwise, our budgeting is going to fall short for this year, blah, blah, blah. All of that stuff, right? So I can put some links in the description on providers and platforms that I use, that I recommend. And I could potentially even get you a friendly discount, so to speak, on that, depending on the market you are in. So just drop in the comments if that would be helpful, but you can find that stuff in the description. Rent hurdle. Okay, now we're talking. So we kind of talked about all the revenue stuff. Now we're going to talk about, all right, now we're getting into costs. We've got a bunch of, I like to group it into property, operational, and overhead costs whenever I talk about costs, which break down into way more detail. If I have a look here in the detailed model, we've got all of our different inputs there, but it's very specific to you. And they have different ways that they're applied to the model. Some are per head count, some are per square feet and everything. But the rent hurdle is interesting because as an owner, let me just think about how I want to say this. Okay. So this is a management agreement proposition that you're putting to the owner, which means you're essentially, as a partner, going to design, build, and operate this co-working space with the owner. You are not you're not paying rent like a traditional tenant, because you're going into business together, essentially. And we'll get to how your fee structure happens if you're the operator working on this. However, if you're the owner, you want some form of guarantee, right? And normally the guarantee is the full rent when they're dealing with a tenant. But with you as the partner who's working really hard to fill this and make it bespoke to their building, you normally agree to a rent hurdle. And what I've modeled here is, let's say the target market rent is $25 per square foot. We've assumed 33% of that as the rent hurdle, which is $8 per square foot. And all that means is that whether it's guaranteed So this depends on how you negotiate, whether it's almost like a third of the rent that you guarantee that you pay independent of success, or whether it's a waterfall payment structure that as the money comes down and comes through, the rent hurdle gets filled before any operator fees does. So it's a priority of payment kind of situation. Rent hurdle is important. And, you know, I've seen rent hurdles as low as 20%, as high as 80%. And the 80% one was ridiculous, but this was a particular scenario where honestly, you know, the stakeholders involved were a bit wacko. Okay. So the management fee structure. As an operator, there's really three things that you look at. There's the rev share percentage. So what percentage is your fee of the revenue of the co-working revenue? In this situation, I think, yeah, we set it at, I think, 8%. Is that right? 7%. Silly me. I'm looking at the wrong thing. 7%. This percentage can fluctuate. It depends on how much revenue you have. If this site is significantly like 2-3 times the size of this and there's a shit ton more revenue, even though there is a lot more effort to fill it, that rev share percentage probably comes down a tad, 5 to 6%. Excuse me. And again, if it's smaller, let's say half the size of this, that rev share probably goes up closer to the 10 to 20%, right? Because your revenue pool is significantly less. Profit share in this scenario, I've pegged to 8%. Again, when you think about it, the profit pool is lower because of the rent hurdle. So because of this 33% that we've negotiated, that kind of gets paid out and pulled out of costs before any of this stuff is paid, because it's now a cost line item, the way profit is calculated has been decreased. Because if there was no rent hurdle, profit would be more, because that $8 per square foot would just flow into profit, and then you'd split it with the owner, right? So 8% because the pool, well, when we look at the commercials, it's not too bad. When you're looking at 8%, you're earning by year 2 about an extra 50,000 US, right, on top of your fee. And to me, those rates look good for a space of this size as an operator. And if you're an owner doing this yourself, it's not as simple as saying, I can do all of this and pocket that. You're going to need help running it, right? If you're an owner/operator and you're thinking of doing this self and these margins look great to you, you're in a unique position where you could really make this work for you because you're sitting on both sides. And then it's just a matter of how you want to treat building costs, capital, right? But we'll get to the market rent equivalent shortly. KPI I put in here because certain operators like to negotiate a fixed base fee. So before the rev share of 7%, they'd like to say, hey, okay, in year 2, if my rev share of 7% is 121,000 US dollars, I'd like 50,000 US guaranteed for me every year, because there's that much effort that goes in that should be independent of the rev share. So some operators like to ask for that. But then also the KPI should be attached to a profit share, so you don't just get the 8%. Are you reporting on time? Are you responding to calls and emails? Are you doing all this kind of stuff? You can bake a lot of that relationship stuff in there under the KPI to make that landlord feel a bit better. CAPEX for this particular one, if I scroll down here, we treated the CAPEX for this scenario, I think I went relatively light. Yeah, so we assumed $110 per square foot. In terms of CAPEX, I assumed about $10 per square foot ongoing. So like, you know, for refreshments, refurbishments. But then I also assumed a $60 per square foot TI in this market, which means in total, even though the CAPEX, and like if I'm looking at this model here, so let's look at the model. You've got your CAPEX, but you've also got your year 1 setup costs, which are about 100,000 US, which mainly is pre-hiring some staff, paying for some pre-marketing to get some buzz of the space, setting up the internet infrastructure. That's the 100K. So it's about 1.9 mil in total to the landlord in this situation under the management agreement, but because of the TI that the landlord would normally have presented to a tenant in this situation, majority of landlords go, okay, well, I would have been out of pocket about $1 million with a TI incentive of $60 per square foot for this size space. So in theory, I'm going to look at this as a circa $9.7 million CAPEX investment into this co-working opportunity, which is important because then when they look at their ROI, it's a 3-year payback, which is actually not bad at all. Okay. And this comes back to the landlord profit target. Even though the market rent target here is $25 per square foot, the owner can't walk away just with that if they're going to be putting the capital in. They need to see a premium both for risk and both for CAPEX. Why are they doing this? Why are they, aside, there's a bunch of soft drivers and answers to that question, but why are they putting the risk into this if there's no reward? And if they're going to be the one funding the close to, did I say 9.7 million? Sorry, everyone. 970K. Let me rub that out. Silly me. I haven't had my coffee. My son Logan fell asleep right before I came in to do this video. So I couldn't make myself a coffee. The machine is relatively close to where my wife and him nap. So I was like, oh, so I'm doing this so apologies. My mistake. That's 970K. So yeah, the CAPEX of close to $1 million. So that's why in this scenario, by year one, we're seeing like close to $42 per square foot, which is like, oh my God, that's incredible for the owner. Why wouldn't you do this deal? But you got to think about everything else that they're putting on the table. Okay. Yeah, I think, what I'll do now is I'll stop recording here, but I'll move over to the financial model real quick for you to help just kind of close this strong. But reach out if you want to do something like this in detail together, or if you've got questions, chuck them in the comments. But all the assumptions that we just went through around the revenue should make sense. Private office desks, let's look at year one. So I'll highlight this, year two, sorry. You can see majority of the income is through private office desks, which is pretty standard. But also again, to what we talked about, you're selling these 12 months plus at a time. Open plan, dedicated desk, hot desks, yeah, cool, just a bit. Meeting rooms, this sucker could double, triple if you do this properly, but you don't want to forecast that confidence because you don't know because they're sold per hour. But I think meeting rooms is really where a lot of operators are looking at this year moving forward to have great years. Because you sell your offices, right? But if you pump that meeting room utilization, I've assumed about 20% utilization this, and even that can be rich in some markets, to 30, 40%. Whew, your P&L is going to look great. Your fee is going to look great. Your landlord's going to love you. Event spaces, I always historically forecast low. I only used an 8% utilization here because they're harder than meeting rooms. Unless you've got someone dedicated selling that, and I'm not even counting the third party platforms you can list with, very hard. Ancillary revenue, the stuff we talked about on the extra stuff. So you've got your co-working operator costs, your property, operational, your overheads. These break down into a lot of detail. If I jump into the detail model here, it's like repair and maintenance. It's like operational costs, overheads. Maybe I shouldn't show that on the screen just because there's just way too many inputs that'll blow your mind. But I'll show the flex operational cost breakdown here. So you can kind of see you got your internet network. This is all market specific. So you got to figure it out. Your amenities, so things that you don't think about, right? It could even be like plants in the area. Do you want biophilia, which people love? What's the cost of retaining those? What are you doing for your activation budget? What are you doing even on like swag for members, all that kind of stuff? All that kind of goes in there. But your building operating cost is really important to also understand. What does that cost? So this is, what the owner normally charges to clean your general areas, the utilities for the building, everything. That has to come out as a cost. Right? And, some models like to show this as additional revenue to the owner, but the owner's not going to put that into their pocket for CAPEX. That's a cost for them too. So we just model that as a cost and that just gets taken out. The rent hurdle equivalent that we spoke about, and then your operating fee as a co-working operator. You take all of that out, you got your gross profit, and then you have your profit share mechanism to split it. Your total annual income, the delta here, this is where you can get excited. You're going, oh man, we're almost doubling rent, $16 above the 25. It's because you need to facilitate that payback period in the bottom here. Healthy payback, healthy model, and we'll stop there. So let's hope that this was recording. Stop. Was recording, everyone. Thank you for your time. If you made it to the end, let me know in the comments. I'm very curious to see who watches this to the very end, because these are long ass videos. I could probably optimize this, but because I do this for fun and just to be helpful, I just point and shoot. It's interesting, right? If this, like, I enjoy it because it's helpful and it's on the side. If I had to do this for a job, I probably wouldn't enjoy it at all. It's like that saying, if you enjoy coffee, don't be a barista, right? Okay. Well, have a great weekend wherever you are in the world, and I'll speak to you again soon.